Okay, good morning, everyone. So thank you for joining us today for ESMA's webinar on two very interesting topics. So on social media influence on financial markets and on crypto assets trading. My name is Aleksandra Bojanic. I'm from the ESMA communications team. And before we start with the program, I will provide some relevant technical information. So please note that the webinar is recorded and we are going to publish a recording after on ESMA channels. And we are also going to provide the link to the recording to all attendees together with the presentations. For the Q&A session, so we will have the session after the presentations, but during the webinar, you can provide your questions using on top of your screen Q&A option. And please know that all attendees are muted and with camera turned off. So you are not going to be able to unmute yourself during the webinar or turn camera on. So this is all from me. So I believe we can now start with the webinar. And we will start with the welcome remarks from Mr. Stefan Kern, the head of Economics, Financials, Stability and Risk Department. So Stefan, please, the floor is yours.
Thank you so much, Aleksandra, for the introductory words, and also a warm welcome from my side and a good morning to all of you. It's great to have so many of you taking an interest in our webinar today, which is dedicated, as Aleksandra has already pointed out, to two topics that are very close to our hearts at ESMA, because they deal in particular with issues around investor protection, which is something that we take very seriously. One dimension that we're casting light on today is research that we undertook on social media. The second one is dedicated to crypto assets, two very topical issues. And we are very pleased to share our research and analysis with you on the current occasion. And of course, no need to say that this is a research-based webinar today, where we want to discuss and share with you our findings. Of course, it's not so much focused on policy issues that might be going on around these topics as of now. Now, just a few words on the content. Social media, of course, is a big topic. The platforms are used extensively and in a growing way by investors these days, and they're able to share information, opinions, and views at a very large scale and in real time. And the problem, we have pointed to that in various communications in the past, is that the quality and validity of the information shared by individuals in that way cannot be taken for granted. Now, of course, in this respect, social media postings are fundamentally different from journalism, and we need to understand that specialized financial media are held accountable for the accuracy of the information that they report, and social media postings are not in that respect. And of course, one of the problems is that investors might not be aware of that fundamental difference. So we look at how social media impacts, in particular, equity markets, and we find a significant correlation between social media interactions and stock returns, excess stock returns, in particular in the short term, and that social media platforms indeed influence investor trading choices, and with that might actually amplify short-term financial market movements. Now, these dynamics raise a number of investor protection issues, but also point to potential problems around orderly markets. And we try to gain a better understanding of the link between the social media platforms and the developments in the markets. In that respect, of course, our analysis contributes to ESMA's investor protection mandate, and it also forms part of our ongoing efforts to monitor the underlying risks of social media to retail investors and to the markets at large. The second topic that we look at today is crypto assets, in particular the market structure and the extent to which these developments are in fact of EU relevance. No need to underline the importance of this. Crypto assets have developed into a very extensive system, current market valuations around $2 trillion US, And it's not only anymore a system that is a closed systems on the side that runs parallel to the traditional finance as we know it, but increasingly so we see interactions and interconnections developing between crypto asset markets and traditional financial markets. Here too, we see risks to consumers. No need to mention that. And in the past, again, ESMA has alerted financial markets and consumers there to the very fundamental risks that are involved when investing in crypto assets. But we also see potential risks to financial stability. Now, of course, we monitor these risks on a continuous basis, and we've published widely on the topics in the past. You may remember that we have had analytical articles on crypto assets and specifically the risks for financial stability back in October in 2022. And last year, we published in particular on decentralized finance in the European Union, both on the developments and risks, and then also taking a deep dive at smart contracts and what they mean for the market. In the article that we're discussing today, we provide a detailed overview of the patterns in crypto assets secondary markets. The aim there is to improve our understanding of crypto asset trading and the extent to which it is either similar or very different from securities trading in traditional financial markets under MiFID. A second objective is to identify any current or potential areas of risks, and of course, in doing so, also to support the implementation of MiCA. Now, MiCA, of course, is the first of its kind legislative framework at large scale that regulates issuers of crypto assets, but also crypto asset service providers. And these provisions will, as you are acutely aware of, from June this year. And the implementation work is currently ongoing. And like we said, our analysis contributes to that work. Along these lines, the two presentations that we will see today will share with you the findings that we have. And I'm very pleased to first introduce on the topic of social media influence on EU equity prices, Lorenzo Danieli. He's a risk analysis officer in the Economics, Risk and Financial Stability Department, who will share with you the presentation of our work. And the results will be discussed by Valerio De Caro. He's a senior policy officer in the Markets and Digital Innovation Department at ESMA and will frame the article in the current policy developments. Then on crypto market structures, those will be presented to you by Paul Reiche. He's a policy officer at the Markets and Digital Innovation Department, and they will be the findings will be discussed by Anne Chaunet, the senior risk analysis officer in economics, risk and financial stability. So we're looking forward to two very informative pieces. And of course, we're looking forward also to your interest, to the questions that you may have. And Alexandra also already introduced you to the mechanics of submitting the questions. In any case, we are very pleased to hear what you think about our outcomes. The two presentations will in that spirit be followed by a single Q&A session at the end of the webinar. Please do submit your questions through the chat box. We're very much looking forward to this. Welcome again to the webinar today, and it's now my pleasure to hand it over to Lorenzo for the first presentation. Thank you very much.
Thank you very much, Stefan, and good morning, everyone, and a big welcome also from my side to this webinar. So I will first introduce this new article that we just published on the influence of social media messages on EU prices. And before going into the analysis, just a small background on the potential risk related to social media use, because in the past decade there was a huge social media expansion in terms of numbers. As of the first half of last year, about 4.8 billion social media users globally, which represent about 60% of the total global population, and each of them spent on average about 2.5 hours on social media. So the expansion of social media also brought greater immediacy and convenience with which information spreads across users, and this makes it appealing particularly for individuals. In fact, interaction on social media have also been increasingly influencing investors and trading decision of retail investors. Also, previous literature has shown that consumers are influenced and rely more and more on interaction with other amateur investors rather than actually seeking for expert advice. This has the potential to increase the consumer exposure to large losses, especially if they receive wrong or false information, and especially if they have a low level of financial literacy or a limited set of information linked to financial products. This speculative nature of social media advices also raises, on top of investor protection, raises two further concerns. One on market abuse, and we will see also later in the discussion, and second on ordinary market, because the social media coupled with increased retail trading can also have wider implications on terms of price dislocations. So what do we do in our article? So this is to the best of our knowledge, this is the first analysis that focuses on EU stocks and that takes into account several social media platforms rather than a single one. Previous analysis has focused mainly in the US markets, trying to link the effects of social interactions on financial decisions and stock prices, but also previous analysis focused on a single social media platform, which was Twitter. But at our end, what we do is we look at several social media platforms thanks to a new database on stock pools that allows to retrieve data across several platforms: Twitter, YouTube, Instagram, and other social media, and also across EU stocks listed in Europe. What do we want to do? What we want to do is to understand whether social media sentiment is linked to stock market dynamics. So we basically do two main tasks in our article. First, we want to look at the correlation between social media sentiment and stock return. And secondly, we want to understand whether general interest in general social media interest, meaning an increased number of social media messages on a particular stock, further fuels changes in stock excess return. Quick anticipation of our findings. So we find correlation between social media interaction and excess return, but this is an effect that lasts only in the short term, meaning on the same day and the day after the social media message occur. And therefore, we concluded that there are no significant gains from social media advices, nor investors can base investment strategies on social media advices. So, in order to do the analysis, we focus on, as I said at the beginning, European stocks, most in particular on the stocks 600 equity index. We start from roughly 640,000 initial observation that boil down to 300,000 after cleaning, covering 580 stocks belonging to the index. And we take into account two main variables. First of all, variables linked to social media use. So total number of messages, which include neutral, positive, and negative messages, and then stock market data, which represent our main dependent variable. So we retrieve this data from Refinitiv Icon, and from there we are able to extract the closing and opening price, the volatility, and the market cap measures. So we take into account a period that goes from 2019 to 2023 to see the evolution over almost 4 years. So before going to the results, let's see what we see in first instance. For example, the chart on the top left shows the evolution of the total number of messages over time, split by positive, negative, and neutral messages, and these are plotted against the stock 600 price. First of all, what we see is that since the beginning of 2021, there was a large increase in social media use by individuals around to post messages around the stocks the components of the stock 600 index. So the jump that you see in 2021 is not driven by better coverage, but exactly by two factors. First, greater use of social media, and second, is driven by some individual stocks that were frequently mentioned due to events linked to the companies. And the second thing that we can observe in the graph is that there is no clear relationship on aggregate between the price and the social media messages. And this is also confirmed by the bottom chart, where we see the share of positive to negative messages plotted against the price, that we don't really observe on aggregate such any movement. This is why we needed to investigate further and take a stock level approach to understand whether there is any link between prices and social media. So what we do, it's a panel regression with fixed effects, and here I will mainly focus on the variables that are under our interest. So first of all, as dependent variable, we use daily excess returns, which is the difference between the stock return and the index return, calculated as the price change from the previous day to the same day. And then our variable of interest are two, as I said at the beginning. First is the sentiment variable, which is the difference between positive and negative messages over the total. And this really captures social media sentiment, in the sense that if this ratio is negative, then we have a period of negative sentiment. If the ratio is positive, otherwise. And we calculate these variables daily. And the second variable that of interest is our attention variable, which is based on the number of messages that are posted on social media platform every day. We rank this every day. We rank the number of social media messages in the percentile distribution, and if the ISIN falls above the 90th percentile distribution of the total messages on the ET, then it's signaled as a frequently mentioned ISIN. If it doesn't do so, then the dummy variable will be 0. And then we also interact these two variables to understand whether a change in sentiment for the most mentioned variable also is a contributing factor to daily excess returns. And then we also control for a set of company-specific and market-specific variables that include the cumulative return of the stock for the previous 5 trading days, the size of the company, and also some market measures to control for volatility and illiquidity. So What do we find? We find, as I mentioned at the beginning, positive association between social media sentiments and excess return. Meaning an increase in positive sentiment leads to higher return, but only on the same day in which the social media message is posted and on the following day. We also observe that the coefficient loses significance as we extend the time windows to 5 and 10 days. Another interesting result is that the stocks that are mostly mentioned on social media, this effect is lower. This is because when stocks are frequently mentioned on social media, they're normally mentioned because of bad events, and therefore there is a more negative sentiment across the stocks that are classified as popular in our sample. However, a change in sentiment for this particular group of stocks, as the last row shows, has the effect of further increasing the effect on returns. Therefore, the hype around specific stocks has the power to further boost these effects. Again, very important is that these effects are only transitory and have only a short-term are of only a short-term nature. So, in order to conclude, and before handing over to Valerio, just a few remarks. Again, we find this correlation, which is amplified by attention for given stocks, but it is important to stress out the fact that social media activity does not lead to financial gains, particularly in the long term, and it's not convenient actually for retail investors to predict and plan investment strategies based on social media advice. Thank you very much for the attention. I will leave the word to Valerio for.
So, apart from the analytical and statistical work, ESMA has conducted as well some policy-related work, obviously due to the increasing relevance of social media. At the beginning, let's say the focus, our main goal was to capture, to sort of frame the figure of the influencer within the market abuse regime. As you can imagine, when the market abuse regulation 10 years ago was issued, the regulators at that time didn't have in mind the figure of the influencer. So the first part of our policy work was to capture that figure within the existing already regulatory framework. So we started from this very specific object, and we obviously we then developed it into a wider study. This wider study encompassed obviously sharing among NCAs their experience when monitoring social media, and obviously the challenges that the NCAs are still facing as of today when monitoring social media. Another part of this wider policy study was to detect and study more in deep which are the most common abusive practice that take place in the social media and via the social media. such as, for example, the spreading of rumors, other strategies like pump and dump, and so on. So what we did in our study was exactly to define and a catalog, a list of the most common abusive practice that take place through social media, and obviously provide the tools to the NCA to be able to prevent and mitigate the risk of these abusive practices. In the next slide, so we see which are the result of this study. At the end of last year, at the end of 2023, we published two different documents. One is in the form of a supervisory briefing, which was included in the ESMA handbook, so a sort of guidelines for the NCA when monitoring the social media. And the other was a more, let's say, targeted for the public, for the general public document in the form of a warning, which is published on the ESMA website, which has been advertised to the ESMA social media channels. And in this respect, I warmly suggest you to have a look at this warning, have a look at this document, because it contains some very important notions that we should all know and that we should keep in mind when posting something on social media, because this can have some relevant consequence. With this, I'll stop here and hand over to the next colleague.
So I have the pleasure to now present an article on crypto asset market structure. This was not only written by myself, but also co-authored with Malena Calisano and Filippo Giolini. So also some credit to them. And I'll just lead you through our main findings, starting with like the motivation and then going into the different chapters and then some concluding remarks before handing it over to Anshone for a quick discussion. So first, what's our motivation? Why did we write this article? What's the idea behind? So big idea, of course, no surprise. We aimed for understanding kind of the market structure. So yeah, to what extent it resembles traditional markets, and or maybe also how it differs from traditional markets. We have, of course, perceived that crypto assets, they follow kind of boom and bust cycles. It's kind of a very volatile market, but nonetheless, it has really grown from nothing 10 years ago to around 2 to 2.5 trillion US dollar in market capitalization. So there's really a big amount of investor money that flew into this market segment. And so it's was definitely something worth monitoring. We as ESMA, we have the mandate to protect consumers and ensure orderly markets and financial stability. So all the analytical activities we're undertaking are of course under this kind of umbrella. So kind of analyzing from a perspective of consumer protection, orderly markets and financial stability. And we're doing some monitoring activity and risk assessment, to follow trends in the market. This report is largely based on commercial data. So right now, as many of you know, crypto assets is largely unregulated. So there is no kind of regulatory data which we as ESMA, as a regulator, might obtain. So all of our analysis is based on commercial data, which is to a large extent self-reported and therefore also anonymized. So we can't really see in our data set where trading volumes are coming from, where matching of trades is performed. So we kind of see trade level data and order book snapshots, but we don't really know who is behind this activity. And self-reported also means, of course, that to a large extent we can't verify that those transactions we are seeing in this data set, that they really took place as they are shown. Moving on to the first kind of analytical section now, which was around crypto assets. Our first finding, and maybe one of the most notable findings, of course, it's no big surprise, but just to kind of shed the light again on this observation, is that the crypto market, if you're comparing different assets, it's quite concentrated. So in this table on the left, we are showing the market shares of different tokens by trading volume and by market capitalization. And what we are finding is really that although there exist thousands of crypto assets out there, that the large chunk of the market is kind of concentrated in three assets, namely Bitcoin, Ethereum, or Ether to be accurate, and USD Tether. So this is around 75% of the market cap and 50% of the trading volume. Also with the trading volume, since we are aware of the caveats of the data set, we rather perceive it as a lower bound. It might even be more trading volume in these three assets. And yeah, so highly concentrated as main message. What we found as well is that stable coins, they are more liquid, so they are more often turned over than other crypto assets, which kind of goes back to their way of working for the crypto ecosystem. So stable coins are kind of pegged to a fiat currency, and within the crypto market, they also take the place of fiat currencies. So they are kind of stable in their value, and they are mostly used to cash into and cash out of other crypto assets such as Bitcoin or Ethereum. So that's why their trading volume is kind of naturally higher than for other coins. Like it's like that fiat money is more liquid than any stock because it's turned over more often. What we also found in terms of crypto assets is that they're highly interconnected in their price movements. On the right-hand side, we've plotted some price correlations between the largest native tokens out there, and we found that kind of everything is really correlated and interconnected. And if one token moves, for example, Bitcoin, the whole market is following. This is kind of in contrast to traditional markets where you have several segments, let's say growth stocks and value stocks, or developed markets and developing markets, which kind of always move a bit contrarian or are not as strongly correlated as you find it in the crypto asset system. So in summary, highly concentrated and very interconnected. Next, we looked at trading volumes. So what kind of crypto assets are traded on centralized exchanges? So we looked at off-chain data. So this is all kind of reported by centralized exchanges as well, like Binance, Coinbase, etc. And we looked what tokens are swapped against each other. So crypto trading, it's, yeah, I would say similar to kind of currency trading where you can swap everything against each other, Bitcoin against Ethereum, Ethereum against US Tether, Bitcoin against US dollar. So it's kind of very flexible. And on the left-hand side, we plotted a graph where we kind of tried to disentangle those trading pairs by their nature. And what we found is that the largest part of crypto trading is really taking place in those trading pairs between traditional native cryptocurrencies such as Bitcoin and a stable coin such as US Tether. And yeah, this kind of confirms what we found earlier, that stable coins, they're just turned over more often. And here we see, of course, also that their share in the trading volume is way larger, reaching from like 60 to even 70%, depending on how you're calculating, if you're averaging or looking at single months. What we found on the contrast is that the trading volume, which involves fiat money, so when you're really cashing out from the crypto system into the traditional system for US dollar or euro, this share of all the transactions is way smaller, 20 to 30%, and this indicates that kind of lot of the trading activity which we're seeing in crypto markets, it's kind of self-referential, so it's internal. So it doesn't really touch the traditional system per se. I mean, of course, all the caveats involved, this is just centralized crypto exchanges. It's like a part of the market. As Stefan has in the introductory remarks, there's also some interlinkages growing. We've heard of the crypto ETFs, but at least that's what we are finding for this segment. On the right-hand side, we've just split the, it's the dark blue part on the left chart, so the crypto fiat call volume into its components and what fiat currencies were involved. And what we are finding is that the market largely still relies on the US dollar and the Korean won, which are, let's say, the on-ramp and off-ramps into crypto markets. So whenever you take the money you have in your bank account and you buy crypto, one would assume that you're taking your national currency because it's just the most convenient. And so this can already give kind of an indication of where, from an geographical standpoint, the trading volumes are coming from. While the euro, it's really 10%. So it might be that in the end, Europe as market for crypto trading is not as developed as the US or Korea. Moving next to crypto exchanges, where the picture is kind of similar to what we've seen for crypto assets. In the first place, we find that the market, in terms of where tokens are traded, is highly concentrated. So we see that 10 exchanges alone process around 90% of global trading volume. So all our analysis is looking at global crypto trading, and one exchange alone, which is no surprise, Binance, has right now, I think, a market share around 50%. So it was, as you can see in the left-hand chart, it was really growing until the end of 2022, had like a market share of 60% of global trading at some point, and now it fell back a bit. I think now in March, April, it's around a market share of 50%. And then you have the unsurprising follow-up exchanges. Also no surprise in the names, I guess, Upbit, Coinbase, OKX, which are names that people recognize in the crypto space. We have also looked at kind of the geographic distribution of trading volumes. So this is kind of a very manual exercise. So this is on the right-hand side, where we try to look at publicly available information and try to kind of pinpoint exchanges to where they state they are based, like their headquarters. And we found that many crypto exchanges are still kind of headquarters in jurisdictions which on some lists are labeled as tax havens. Sometimes crypto exchanges also claim to not have a headquarters. So this is kind of really a very intransparent space, I would say. And this, of course, matches the trading volume, and again, all the caveats involved that trading volumes might be inflated from some exchanges, and maybe those volumes from non-tax haven countries would be more reliable. But this is just at least a picture as we are seeing it in the current data. Moving on to our last slide on the crypto exchanges, we've looked on exchange liquidity. So we've analyzed two liquidity metrics on order book liquidity, which is first bid-ask spreads, and then order book depth. So kind of the amount of standing orders in centralized order books of crypto exchanges. And what you're seeing on the left-hand chart is the distribution of the bid-ask spread for Bitcoin trading on different exchanges. And what we are finding is that for really the largest exchanges, this bid-ask spread is enormously small. So what you're having on the x-axis is a denomination in basis points. So you're really seeing like an average bid-ask spreads of 0 point something basis point, which is extraordinary small, which in the end might, of course, be a reflection of first, a lot of kind of let's say, highly frequent trading activity. And second, also, of course, that Bitcoin, this is only for Bitcoin, is kind of denominated with, I mean, right now, a price value of 60,000. So if you take a basis point of 60,000, you're still at 60 US dollar. So still, it's also this kind of denomination effect. And the largest exchanges, they are like way more liquid, have way tighter spreads than the median exchange in our sample. We've also looked on the distribution of liquidity across different assets. So on the right-hand chart, you see order book liquidity at Binance for different assets. And what we found is that especially Bitcoin and Ethereum, they stand out. So on the y-axis, you have trading volume. On the x-axis, you have, again, the bid-ask spreads and basis point. And really, you see Bitcoin, highest trading volume, lowest spread. Ethereum, similar spread, a bit lower trading volume. Then it's kind of tailing off for the other assets. Summing everything up, I think this is just a bit of a repetition now, so I'll just go over it very quickly. We found that the market is kind of very volatile and highly interconnected. It is concentrated on the asset and on the exchange level. We've seen that fiat is involved in the minority of transactions, so only 20 to 30% of transactions is kind of the interconnection between the traditional world and the crypto system, and on the other hand, 60% of the transactions, so of the trading volume, is related to stablecoins or involves stablecoins. And last but not least, we also found that still it is kind of also due to the lack of very transparent data for us as a regulator. It's very hard to kind of see where transactions are coming from, where trading volumes are originating from, where they are matched, where entities are based. And so at the current juncture, there is, at least from our point of view, still a lot of intransparency involved. And with that, I'm handing it over to Anshone, who has a few discussion points on our findings and yeah, some further ideas for future research. Thanks.
Thank you, Paul, for this very useful overview of crypto asset markets and also trading patterns. So indeed, I'll share a few thoughts on those findings and also some thoughts on possible areas for future research. So I think you rightly highlighted this high concentration that we see, and what you see on the screen now is just another illustration of this high concentration, and also the fact that crypto assets tend to move in high correlation with one another, contrary to what we see in traditional markets where we see more diversification. And so what you see is just, so, you know, if Bitcoin is in the red, you see that most of the universe follows. But I think what's interesting in those findings is that although it's fair to say that we have a very high concentration, at the other end of the spectrum, we'll still see a very high number of crypto assets being made available, and we also see a large number of trading platforms offering their services, which has important implications for consumer protection in terms of the risk we see, and also in terms of how the ecosystem is developing. So moving to the next slide, I think in that respect, it's interesting to take a step back and look at what's the value proposition of those coins. And I think the reason why we see so many crypto assets being offered is because it's very easy, effectively, to create your own coin, to make it available, and to try to, you know, collect money for that, and try to have it traded somewhere. This has again implications in terms of the risk for investors. I mean, what's really out there, and we see lots of coins being created for no good reason and disappearing. So scams, fraud, so really issues in terms of investor protection. So we did a small, I was just, briefly looking at those large crypto assets that we have out there. And I think it's interesting to take a step back and ask ourselves, so what are they aiming to achieve? What are they planning to do? And this is a work that we did a while ago at ESMA when there was the ICO bubble, and we wondered, what are the rights attached to those cryptos? What do they provide to their holders? And when we look at I just took the 10 largest coins out there, and so obviously Bitcoin, Ether, Solana, Avalanche are on the list. And I think what we see is two broad categories, I would say. So on the one hand, Bitcoin and those coins that are intended to be used as an alternative means of payment. So I would say the Bitcoin and the copycats, or the copy dogs, I would say, because some use a dog picture, as you know, to promote their usage. And on the other hand, we have the Ethereum and the likes, which are intended to create a new infrastructure leveraging on the blockchain technology. And I think what's striking is that at this point, if you look how these coins behave through time, there's no clear distinction by the market in terms of what the value proposition of these different coins are. And I think it shows in a way that the market is still has to mature and still has to grow in a meaningful way. So two main categories of coins, and I was interested to look at the valuation of those coins and compare them with the valuation of large companies out there. So, and tech companies and financial companies as well. So I won't comment on those valuation levels. I will just let you have a look. And so, for instance, Meta stands in between Bitcoin and Ether in terms of market cap. So let you decide whether you think it's relevant or not. And you also see that, for instance, Dogecoin has a market cap that is close to Société Générale, for instance. So just food for thought for us and for investors as well. So maybe looking ahead and what comes next for us as regulators, supervisors, and what's interesting in terms of research. So Paul highlighted very rightly the many challenges we have in terms of the data gaps that are there in the crypto domain. So what he used for the analysis was data from centralized exchanges, self-reported by those exchanges. So very insightful, but with a number of limitations, because we know that most of these exchanges are not regulated at this point, so may not comply, with things, with safeguard that we would traditionally see in financial markets. So important data gaps. So within the EU, we're of course very much looking forward to the implementation of MiCA. MiCA, as you know, will set a comprehensive set of rules for crypto assets providers in the EU, and also for issuers of stablecoins. So with MiCA, we'll also see how the ecosystem within the EU evolves. Importantly, MiCA will give us access to more data. It will not address all the data challenges that we have now, but hopefully we'll have more data with MiCA coming, which will be very much welcome. If we look ahead in terms of what we'd like to have, in terms of what research we think would be useful, so of course on-chain data will be a very interesting area for further research to allow us to have a more comprehensive view of those trading activities that Paul described. The development of decentralized finance is also a very interesting area. Lots of challenges for us regulators because of the technicalities involved. But for instance, if we think about trading activities, we know that trading activities are increasingly taking place on decentralized exchanges. We know that that there may be some information asymmetry between centralized and decentralized exchanges. So these are areas that we'll need to look at more closely in the future. Finally, I'd also like to say a quick word on tokenization. So this is something that has been around for quite some time, that has been discussed for quite some time. I think we're still waiting for the killer app, if you wish, in the tokenization space. But I think it's interesting to the extent that it could bridge the two worlds of traditional finance and crypto finance with the use of DLT technology for more traditional instruments. So an interesting area for future research here. So I think we still have 5 minutes for the Q&A session, which is great. So I'll pause here and hand it over back to my colleagues, and just to highlight that you're very welcome to raise questions in the chat on both presentations, so crypto and also the previous presentation on social media. Thanks for your attention.
Thank you very much, Anne and Paul, for the presentation. Very interesting. So I guess we can introduce now the Q&A session in the last 5 minutes of this webinar. I will start with some questions on the social media article, and then I will leave the word to Paul for the questions linked to the crypto article. So in particular, first of all, thank you for those that have submitted the questions, and we received 2 questions. One on what we mean by social media post, and another one about future work on whether we plan to look to what extent the social media interaction influence trading volumes and the related volatility, and whether transaction level data as those available through MiFID reporting could be a source, relevant source for use. And the same participants also asks whether we plan to carry out analysis in the realm of crypto assets, given also the trends, and then Paul will comment on this. So concerning social media post, the stock pools database, and I link this answer also to another question we received about the database, provides any kind of social media post that is on the platforms. This includes comments, posts, comments, retweets, reposts, and any kind of action that you can do through social media that also has an influence on investor decisions. So in our article, we do not focus on investment advices by influencers, but we mainly focus on, let's say, general social media messages that investors can access. And also the stock pools database has classifies each and every message by its nature, and also it provides the content of the message as well as the author and a breakdown of the nature of these messages, so whether they're positive, negative, or are neutral messages. And also I link this to the future work and what we are planning to do next. So first of all, one interesting avenue is for sure looking at whether influencers advice has any impact on trading activities. So this is very relevant point that was raised. Also whether social media activity has any impact on trading volumes. Definitely we will look into that also with the help of much more granular data coming from MiFID. And one interesting point in this is to disentangle trading volumes coming from institutional investors versus trading volumes coming from retail investors, which really allows to disentangle the effects of social media influence on the two type of investors, and also see which type of investor drives the trading activity. And finally, we will also take a look at whether increased social media activity then has any effect on any other type of products, such as, for example, crypto assets, or whether there is any influence for flows in investment funds. I now hand this into Paul for the questions on crypto.
So very quickly from my side, there was one question on MiCA, which I think I can't really address from my perspective. It was I'm happy to publish it. It was concerning what crypto assets, how to regulate crypto assets that are not caught by MiCA. Just to make you aware, there will be a MiCA review, so might be that the regulation will be adapted. But I frankly don't really know from my perspective. But that means we're spot on time. Thanks a lot for your participation, and have a good rest of your day.